Thank you, Mr. Chairman, and I would like to thank the committee for hearing from me today. I will be speaking on the valuation of coal property for ad valorem property tax purposes. I am a attorney with Jackson Kelly. I have practiced primarily in the state tax area for many years. Basically, the appraisal of coal property involves two essential elements. There's first the appraisal and taxation of the coal in the ground, the natural resource that is being produced, and then secondly there is the taxation of the industrial property which the coal companies use to produce that natural resource. Let me talk first about the taxation of coal. This is done by the state tax department, the West Virginia Code. Back when we did a statewide reappraisal in the middle of the 1980s, made the tax commissioner responsible for all appraisals of natural resource property and all appraisals of industrial property. So the tax commissioner promulgated regulations to value both of these types of properties, and the coal regulations essentially employ an income-based methodology to value all coal in the state, whether it is being actively mined or whether it is not being mined at the current time. You can essentially divide the taxation of coal into two categories: active mining property and coal reserves. There are some other categories for mined out barren property, but those are all valued at a nominal, very small value. But essentially, the appraisal of active mining property begins in May of the year before the tax year, when the producer of the natural resources files a tax return with the state tax commissioner. On that return, they disclose basically how much coal they have mined during the prior 3 years. They describe factors relating to the quality of the seam that is being measured, and the tax department puts that into a computer program which essentially determines, based on the number of acres that they have permitted for mining purposes, how many acres they have valued during the current year, and then determines a mine life based on that data. So a mine that had a 10-year life would have a 10-year stream of income that is generated from the production of coal. That would be generated from that mine, and then using a capitalization rate that the tax commissioner determines annually, they would take that stream of income and bring it back to the present value of the coal in place. What we're looking at in the valuation of coal is basically the income stream that is received by the owner of the coal. So essentially, you would take the tons of coal mined times the price times the royalty rate that the owner of the coal received for valuing it. You would project that for the future life of the mine, and then you would present value that income stream to determine what each particular mine is valued at. At present, there are only approximately 50 or 60 mines operating in West Virginia, so those 50 or 60 taxpayers or those fewer taxpayers with multiple mines will file these returns and pay that tax. I prepared a handout for the committee that will go into some greater detail than I have time to discuss here. And one of the things I would point out at the end of that handout is a chart. There's 2 pages on this just chart, and this shows the total value of all property that has been assessed to, and the taxes that are being paid on that by the coal industry for tax years 2013 and 2014. I think it's important to note that for tax year 2013, coal property, including both the coal in place and the industrial property that is used to produce the coal, was valued for property tax purposes at over $12 billion in West Virginia. They paid approximately $170 million in property tax on that during that year, which accounts for approximately 10% of all property taxes that were paid in West Virginia. As we know, the coal industry has been struggling, and if you turn over and look at the same data for the following tax year, 2014, which is the most recent year available, and this data came directly from the Property Tax Division of the Tax Department. Values of coal property, both minerals in place and industrial, had fallen approximately 11% to just over $11 billion for 2014, and taxes assessed had fallen from approximately $170 million to $151 million. I think it's also interesting to note that this schedule is county by county. 5 counties make up fully half the value that is assessed to all coal in West Virginia. It is also interesting to note that the assessment of the minerals in place is only about a third of the total assessment of property taxes on the coal industry. 2/3 of those property taxes are assessed on the machinery and equipment and prep plants and loadouts that are essential to produce the coal that is being mined in West Virginia. I would direct the committee's attention to the columns on this chart that show the total taxes collected on active minerals and the total taxes collected on reserves. By 2014, I think you can see that there were approximately $50 million in taxes assessed on coal in the ground. The vast majority of that, $40 million plus, was assessed only on the 50 or 60 active mines that we still have working in West Virginia. There was only $8.8 million assessed on all remaining coal in West Virginia that was not currently being actively mined. I earlier discussed how active coal was valued. Basically, you project an income stream for the mine that is producing the coal. You present value that. You determine the total value of the mine by discounting that back to the present value. One of the, I think, clear issues that the coal industry has with the calculation of taxes has to do with this calculation of this capitalization rate. I think as many of us recognize, coal can be a dangerous business these days. I mean, dangerous in terms of you would have to expect to receive a decent rate of return in order to invest your money in the coal industry. The tax department's capitalization rate is the way to calculate that has been set forth in the regulations, but it has hovered around 12% for many years. Many in the coal industry believe that this rate is insufficient, that the rate should be higher, 16, 20%, in order to account for the risk of mining coal. If the rate were increased, that would reduce the valuations of assessed property. That leads me into a discussion of the appraisal of reserve coal. This is coal that's not currently being mined. The regulations that direct the tax commissioner how to assess property contain a formula called the aggregate value formula, and it's an interesting formula, and basically it caps the amount of taxes that can be assessed on any coal, on all of the coal in West Virginia during any particular year. Basically, the assumption is if you take the current rate of production of the coal industry in West Virginia, 130 million tons or less, and you multiply that by the average sale price of the coal, you multiply that by the average royalty rate, that total equals the total of the money that would be coming to property owners as a result of the appraisal of coal during the tax year. If you assume that production will continue at the same rate, at the same price, at the same royalty rate into the future, then you can discount that future stream of income and come up with a total value of all coal in West Virginia. That's exactly what these regulations require you to do. So you now have a calculation of the aggregate value of the coal in West Virginia. You subtract from that the total value of all active mining coal in West Virginia, and what you have left is reserve coal. And so that is the amount by which all reserve coal in West Virginia is assessed. So how do you determine how to divide that pie among the reserve coal? The tax department has come up with a procedure in the regulations called the reserve coal valuation method. And basically what that does is they have developed a geographical information system that essentially has mapped every coal seam in West Virginia and every parcel of property on which coal exists. There's over 100 seams of coal that are recognized in West Virginia, and there's over 200,000 parcels of property that are being valued by this methodology. The tax department then evaluates each of those pieces of property using their computer database to determine essentially when they expect that property to be mined. They have developed 6 factors. I won't go into what they are, but using this 6-factor analysis, they determine that reserve coal, which is not currently being mined, will either be mined in 20 years, 40 years, or 80 years. So they put it in one of these 3 baskets. Historically, if you apply the tax rate to this, historically, if you apply the sales price and the royalty rate and the production to these 3 categories, coal that is valued as in the 20 basket will be valued at about $1,000 an acre. Coal in the 40 basket at $100 an acre. Coal in the 80 basket at only $5 an acre. Because if you expect to get your money out of mining the coal 80 years from now, the present value of that is not very much. That gives the tax department a tentative value for all reserve coal in West Virginia. They then compare that number to the number of that they have left using the aggregate value after subtracting the active mining property from that, and they come up with a factor that they use to multiply by the tentative values to come up with the actual assessed values of the coal. In years when the markets were increasing, when prices were increasing, that factor may have been higher than 1. So if you had a property that was valued in the 20 basket, it may be valued at $1,000 an acre, but after it was adjusted for the market, it might be valued at $1,100 or $1,200. Today, with falling production and falling prices, this value is coming back down. So if you look at the data that I showed, the total value of all coal in West Virginia, of the $50 million, 40 is active, $10 million or $9 million is reserves. One last point, and this relates to the larger basket of industrial property that the tax department annually values for the coal industry. They value industrial property, as Mr. Steger mentioned earlier. They value this using essentially a cost-based method with regard to rolling stock, machinery, and equipment. They use a service called the Green Guide. They apply the green guide value to the property with regard to prep plants and loadouts and other machinery and equipment that is constructed. They essentially take the cost of that, they trend it up to replacement value, and then depreciate it down to current market value. The tax department does allow some adjustment in the case of property that is sitting idle at idle mines. Historically, they have limited that adjustment to 50% for idle property. They have promulgated, this legislature has approved new regs in the last several years which mandate that in case of idle facilities that are indefinitely idle, the tax department is required to value that property at salvage value, or at the value that they could, at a market value at which they could sell it for on the open market. I hope I haven't confused you or bored you too much. If you have any questions, I would be more than happy to try to respond to them.
They will go through each of the three of you, then we'll come back with questions. So, Don?
Okay. Thank you, Mr. Chairman. My name is Don Nestor. I'm, as Mr. Chairman mentioned, a partner in the CPA firm of Arnett Carbis Toothman, located in the Buckhead office, and I'm currently a member of the board of directors of the Independent Oil and Gas Association of West Virginia, IOGA, chair of its tax committee. I'm also chair of the tax committee for the Pennsylvania Independent Oil and Gas Association, and chairman of the Independent Petroleum Association of America, which is the national petroleum industry group. I'm chair of their tax committee. It's kind of one of those, if you've been around a long time, you kind of get moved around up there. So, but because of that, I get involved a lot in oil and gas, and our firm does a lot of oil and gas seminars. And one of the things that I think fits us here, for everyone who represent here, and the assessors and the folks in the state of West Virginia, is I tell folks that if you look at your oil and gas interests, you should consider it like the most valuable jewel that's in your family. That everybody knows who has it, everybody knows who's going to get it. You keep it safe, and you don't want to endanger it. Now, you want to make sure everybody understands that. And I think that's with the oil and gas interests we have in the state. We're very fortunate to have the interests that we have. And what I want to do here this morning, just a few minutes, is kind of go through a presentation of how you value that. The thing that you have in oil and gas is really three different types of property that's valued. One is just non-producing property, which I'll get into a little more detail, and then you have producing properties. Then you also have just the oil and gas equipment, and that's a lot, as John had mentioned, in the industry, it's valued at cost, or in some cases because it's such unique equipment, the drilling rigs and the things are put together. There's various methods, but it's valued pretty much just based on a pretty straightforward approach. The thing that you get into, though, is the other types of properties. And the first one is non-producing property. And I want to give you a little idea of what you find there. It's valued annually per acre by the state tax department. And its values vary from county to county. The difficulty you have is what's a non-producing property that's not being developed out there. It's not generating income. You know, you see situations out there where people transfer these properties, but it's hard to determine what's the actual value of the mineral. And as prices have changed, which we've seen a drastic reduction in prices, where people may have sold the right to drill at a high price a few years ago, no one's talking to anyone now. And if someone was waiting for a higher price, they may have gotten nothing. So it's such a very variable thing. And the real taxation value and the real value of the state is when they drill wells. It's almost like the gentleman this morning talking about, if you have a building that's located in the state, you can't put on a truck and take it out of the state. Same thing with a well. If a well's drilled here, pipeline's drilled, is laid here, that facility stays here in the state. The thing that you run into that on these values by county, and I gave you some attachments, some exhibits that were too small to put on the screen, but the first exhibit A, if you'd like to kind of turn to that, that's provided to the committee, this is just an exhibit of how the non-producing property is valued by county, by district. And I just put in 4 different pages from different counties in the state, and you can see where the activities are. If you look at page 1 of 4, Barber County, the value per acre for this non-producing acreage in some districts is $50 an acre, some districts it's $1 an acre. You go to Berkeley County, where you have very little oil and gas there, no production, it's valued at $1 an acre just to have it in there. Boone County is a little smaller. The next page, page 2 of 4, Marion County, where you've had some activity there, up to $45 in Marshall County, a lot of work up in the northern panhandle. It's in some cases $45 an acre. And if you look at the change from last year to this year, you may have seen in the active counties an increase of $5 to $10 an acre of value. You go on the third page, you get Nicholas County, Ohio County. You can see it's not as high. It's only $30 an acre, but with all the activity going on in Ohio County, I suspect this year's values will be higher. And then the last page is Wetzel County, where you've had a lot of activity in Wetzel County with Marcellus. It's up to $50 an acre. But that's how your non-producing property is valued here in West Virginia. And you can start to see the amount of detail that has to go into this valuation, because you have a lot of activity by a lot of different parties and the assessors. I know, just for instance, in Ohio County, 4 or 5 years ago, they had no oil and gas property on their books in Ohio County. That's drastically changed now, which is very fortunate. The thing that I want to spend probably more time on and kind of gets you more of the valuation of producing properties, there is actually income flowing there, is on these properties. And if you look at the value, it takes care of the value for the well itself, the production of the well, and the equipment up to the point of sale, which could be a pipeline, it could be a separator, it could be a tank. I know there's some discussion in the state tax department as you get these bigger pads with maybe $10 million a well being invested on a pad, and you may have 8 to 16 wells on a pad, depending on Marcellus and Utica formations. You have a lot of equipment between that pad and the point of sale, so there's some discussion there about what's included in the value of point of sale. But these wells are valued higher, and you pay much higher property tax. But if you kind of look in the valuation, you kind of start out, the producer-operator returns are due August 1 of a year, and they're based on the prior calendar year well income. So if someone comes down, it's valued as of the owner July 1 of each year. It takes the calendar year's production from the year before to use as a basis. So July 1 of this year, if you owned an interest in a couple days here in a well, you'd submit your production information for last year, for calendar year 2014, as a starting point. And then you kind of go in the valuation process to say, well, what's that really worth now, because you have certain income. And the next item that I mentioned there is your projected decline rates on the wells, because as you find wells drilled in different formations, they may decline in production. It's almost like the model has been, if you take a Liberty Bell, and you think half of a Liberty Bell, and it declines on a bell-shaped curve. Really high production the first few years, and then you have your flush production that comes out first 4 or 5 years, and then it kind of levels out and may go on for a long time. Well, what they're finding now in the new wells, the Marcellus wells, the Utica wells, that decline rate is faster. And so the state's trying to monitor that, and the industry is too on that. So what I've done is as Exhibit B, and it's a separate handout, there's 4 pages there, and this is just showing the decline rates for different formations. If you look at the first group, and it's by categories in the state, but the first page, 1 of 4, is in the central area, Braxton, Clay, Nicholas County, the Alexander Benson formation. Its decline is the first year is projected in this model to say, what's this well worth? If we have the income flow, how's it going to change in the future? It's almost like if you're buying something, you said, well, what income can I get out of that? And it's the income approach. So they go in, they say, well, how fast is that going to decline? And they're saying the first year should be 31% decline, second year 20%, the third year 10%, and from there on a 10% decline each year. Marcellus on that same page is a 41% decline first year, 22% second year, 9% in years thereafter. If you go on to the next page, page 2 of 4 of Exhibit B, you get into Monroe County, Pendleton County, Hampshire County, over in the areas where you don't have as much production, and you can see the decline rates are similar, but you also have less value down there. The Marcellus is a 59% decline rate. Page 3 of 4, you get into the northern part with Brook and Hancock, Marshall, and Ohio. You can see the Alexander Benson's a flatter production decline, 26%. Marcellus is 52%. So these are all used, and the last exhibit was just for example, you look at the different formations, because values are based on the well-producing formation. You have a numerous amount of formations that you track for valuation. So that's what goes into, you've taken the income that you have in the last year, project what will be in the future, and then the next item that the state gets into in valuing this is the operating cost factors. And those are factors determined where you build into a formula to say, well, if we have the income in the future, now what's the expenses going to be? And Exhibit C was something that the state presents every year, which will be coming out July 1 with some tentative numbers, and then a final resolution for the next year at August 1. But this is what the operating costs will be. And if you look at that exhibit on page 1 of Exhibit C, it has models like your normal costs. Operating costs are soon to be 30% of the income flow that you have, but a maximum of $5,000 a year. If you look down to the third from the last item on that page, for Marcellus wells, the operating expenses are deemed to be 20% of the income with a maximum of $150,000 a year. So they've kind of gone in with a model that says we start out with income, we kind of go in with the projected income flow, the expenses, and then they come back and they have these things, and factors also included in the bottom of the page. If you have a minimum of $500 a well, on page 2 of Exhibit C, you have some interesting factors, like if someone doesn't file information, their working interest goes up 150% from the year before, even though their income's down, a little incentive for people to file. But the state has kind of developed these processes over the years. And these values are determined by the state tax department and on each year. And I threw in Exhibit D, just a little timeline. It was back in 2010. The appeal process has changed some now. But basically, you have this July 1 valuation date. You get your values from the state by the end of the year. One of the questions that was asked earlier was about the Board of Equalization and Review of the values. There aren't many changes in those. The state tax department does kind of represent the value because they're the ones who do the calculation, but there's very little change on the values. And then your taxes for the July 1, say, of this year value are not due until the end of next year, until September of next year and March of the following year. So it's almost a year and a half later when the actual taxes are due because of the processing data. So you can see all the information that's kind of being done here. That's just a rough description of how the wells are valued for the producing wells. Some concerns that we have in the process. And one of the things I'd like to, if I haven't mentioned already, is we've had a very, very good relationship with the state tax department, with the property tax division, with the county assessors, because this is such an important area for all of us. And we've had a lot of really good cooperation on a very difficult and changing issue. As wells are drilled at a higher cost with all kinds of different decline curves and everything, it's been a tough issue to nail down, and also with declining prices. You've had things change, but it's also changed lives of royalty owners. It's given people jobs. It's made a big difference in the counties out there and given some revenue when it's really needed. Some concerns they have, the ones that A, B, and C on this page, this first page, are kind of concerns we've worked with on the state, and it's just the way it is. You know, sometimes because you use an average of the income, if wells only produce for 3 months in a year, that's its highest 3 months of production. Unless you submit information, they're going to assume 4 times that as your first year because it's only 3 months and you get to 12. That is, especially these new wells, is not correct because your income declines when you first start. We use a weighted average of 3 years because if you had income kind of go up in 1 year because prices went up and then goes back down the next year, we've kind of worked out we do a rolling 3-year average, but that also sometimes results in some very high taxes now because now wells may not be producing, prices may have declined a lot, especially Marcellus wells. So we're continuing to work on how to develop that. I've mentioned about the appeal process. Very few changes in the appeal process, and one of the ones that's affected greatly on that are the royalty owners, because when you submit this information into the state for the value, it values the well and breaks it out by the royalty owners, the overriding royalty owners, and the working interest owners. But that's all submitted by the operator. So if a royalty owner goes in and says, hey, my taxes are way up, how could this be? The answer normally is, well, the operator submitted the information, and we kind of went along with what the operator did, or they couldn't prove anything different, so you're just stuck with that. So I think the royalty owner adjustments are difficult, and many times what happens is the answer is, well, you either pay it or we'll just have to go through the process of selling the property. Because the counties are kind of thinking, and they're trying to do a good job. I think the question was asked about the abilities and the time of the county commissioners to appropriately address this. I think those are both factors, but also they are conflicted a little bit because they're trying to balance the budget. And if all of a sudden they're cutting back on revenues and they have people out in the audience who may be depending on that, whether it's education or other citizens of the county, that's a difficult position to put them in. But the states help, but usually very few changes. And the cost models, one of the things that we're also working with the state on, then, again, this is where the state tax department is the cost models, because as the horizontal wells with the higher operating costs are for Marcellus, we don't have a model for a Utica well, which is more common, so that's something we're working with the state. The next issues on the following page, the final issues, are things that we're finding out there that are confusing for all of us. And as I said, we have a good relationship with assessors and counties, but because it's such a large task out there, and a large opportunity but challenge out there, there's some things that have come up. And one of the most confusing issues is concerning how these properties are classified, either as real property or as personal property. If you own the mineral interest in a well, it's real property. And so, for instance, if you don't pay your taxes, there's a process you go through, and you can have a share sale, and your property could be sold if you don't pay taxes. Personal property is different. So you get into this chattel's real property. If someone has an overriding royalty, say, for instance, if I go and John has a mineral and I lease it from John, and then somebody else drills a well and he has a 12.5% royalty, I have a 5% overriding royalty that lasts for the well. My royalty goes away when the well is plugged. It's a personal property. It's a chattel real property. The working interest owner that gets the bill, because it's not only the minerals being taxed, but one of the things that we have in oil and gas is the value of the operated well. It's not just the mineral. It's the income that the operator should get from the well is valued under this producer-operator return, this discussion I presented. And so what happens is that's a chattel real interest. So if that person doesn't pay their taxes, it's a different process of collecting on that. What happens is when the operator sends the information into the state, they identify John as a royalty owner, me as a royalty owner, and then the working interest owner. So the counties, especially the new counties, with people coming in are saying, okay, what's real and what's personal? And the classification can run to other issues. So that's one of the things. The few adjustments of Board of Review and Equalization I mentioned. And then the last item that we found from property tax goes back to the one item I didn't discuss, but the valuation of equipment. July 1 is the valuation date for property in the county, in the state. And many, especially now with all the different companies coming into the state, we may not always get that valued at July 1. And that's been a concern by the county assessors. It's been a concern by the state tax department. We've continued to talk to them about how we can work as an industry to communicate this out there so we can collect taxes where it's due. And also, if equipment is moved from one county to another, which this is moved around the state, which county should be assessing and collecting that tax? So I think that's one of the things that, as this industry is growing and it's been good to develop, we need to make sure we get properly paid for those taxes. And that's something the industry itself has as a concern, as well as the taxing authorities. The last item I mentioned on the last page is just kind of something I mentioned a couple times, is the industry, the oil and gas industry, continues to look forward to working closely with the state, local government officials concerning property taxation, because it's important. It's an important industry to us. It's important to the state and we as citizens of the state, and we appreciate the cooperation and look forward to that in the future. And if there's any questions that the committee has, I'd be glad to answer them. If any questions in the future, it's important for all of us to know what's going on here and do it the right way and do it what's best for our state.
Wonderful. Another piece of very good information. Nestor's areas of centralization that can go on real quick. But anyway, Mike.
Mr. Chairman, members of the committee, I appreciate the chance to visit with you again. I'll introduce myself by saying who I'm not. I'm not Roger Sherman, who is the foremost expert in this subject I'm going to talk about. And I assume I was the second choice because I was the state tax commissioner when managed timberland methodology that we're using first was discussed and developed. And I was also, as an attorney, the only attorney to lose a managed timberland tax case in the state Supreme Court. I'm comforted by the fact that that led to some remedial legislation. So it wasn't all lost, but I want to go through this quickly because I certainly want to leave plenty of time for my good friend Ned Rose to talk about his subject. Oh, thanks. Our original forest in West Virginia, when we became a state back in the 19th century, was substantial, covered a great deal of state, and suffered tremendous decimation through indiscriminate harvesting in the latter part of the 19th century and into the first part of the 20th century. But it regenerated itself partly because they no longer need to clear land to graze draft animals because the Industrial Revolution had changed the use of animals and so forth in industry, and so our decimated forests from the early 20th century had pretty much recovered. But then along came World War II, and we're back to indiscriminate cutting and really serious denuding of our timberland. So to avoid that happening again, this legislature in 1945 adopted a joint resolution that put on the ballot an amendment called the Forestry Amendment to the West Virginia Constitution, and it was adopted by a vote of the people in November of 1946. This is the text of it. Mr. Steger referenced it briefly in his remarks, but let's go through the words because especially the last sentence is close to my heart. But it talks about that the legislature may, by general law, define classified forest lands, provide for cooperation by contract between the state and the owner in planning, cultivation, protection, and harvesting. And forest lands embraced in any contract may be exempted from all taxation or be taxed in such manner, including the imposition of a severance tax or charge as trees are harvested, as the legislature may provide, but, and this is important, any tax measured by valuation shall not exceed the aggregate rates authorized by Section 1, Article 10 of the Constitution, which is where the property tax rate structure is set. Now, despite that constitutional amendment, there was very little done in terms of methodology or the way in which timberland was valued for property tax purposes until we came along to the statewide, what I call the constitutional reappraisal of the mid-1980s, and that's when the managed timberland methodology was first adopted. But 10 years before we ever adopted the forestry amendment, we had a severance tax on the harvesting of timber. And the rates ranged, they went up to 2% in 59, 2.2 in 71, 2.5 in 1980. And that was the value just determined on the value determined by the selling price. And then in 89, we relabeled the tax on timber production, started calling it a severance tax. And as of 87, the rate then was 3.22. Then, as many in the room know, there was a need and a plan to retire the workers' comp debt. Involved the imposition of an additional tax on various natural resource productions, including a 2.78 rate on timber production that made for a total, combined with the 3.22 to 6%. But then in 2007, the basic rate was dropped to 1.22, and so we had an overall rate of 4%. Now, the imposition of the primary or regular severance tax on timber production has been suspended, but it will resume at that 1.22 rate when the governor certifies that the workers' comp debt has been fully liquidated. Now, as I mentioned, this methodology that we now use was adopted as a part of the statewide reappraisal in the mid-1980s. And the key to it is, instead of basing the value of timberland on the land using probably market method or something that Mr. Steger referenced, and the current stand of timber, managed timberland instead is based on the value that's determined by its capacity to grow commercially harvestable timber. So the current provision in the law that provides, well, first of all, makes this finding. I won't go through it, but it really elaborates on the spirit of the forestry amendment and talks about how tax policy needs to provide incentive for private owners to avoid the economic pressures that might force the conversion of timberland into higher and better uses, more short-term higher and better uses, we would say. So the methodology, first, the statute defines timberland generically in a pretty elaborate way. It does not include farm woodlots, which are used to grow certain, nuts, berries, nursery stock for Christmas trees and that type of thing. But it's not less than 10 contiguous acres, which is devoted primarily to forest use, and which, in consideration of their size, has sufficient numbers of commercially valuable species of trees to constitute at least 40% of normal stocking of forest trees, which are well distributed over the growing site. That's in the statute. Pardon me. And managed timberland is timberland, as just defined, that is managed pursuant to a plan that'll maintain the property as properly managed timberland. And then part of that, the owner must enter into first an initial written contract, the contract contemplated in the Forestry Amendment with the Division of Forestry, and then annually certified to the division that the owner will follow the approved forest management practices for that property. Then once property is qualified as such by designation by the Division of Forestry, then the methodology that is applied requires the measurement of the present value of the reasonably anticipated value accretions in the standing timber, growing trees, occurring over a 60-year, and within that there's stages, but I'm saying 80-year, that's one of the stages, growing to a full harvest cycle based in turn on historically weighted stumpage values for different species, the site's soil quality and capacity to grow timber, and then applicable financial factors, which are historic interest rates, various risks, costs of management, and holding the property. That's in the state regulations that address managed timberland. And when you have timberland that is not managed timberland, then it's to be, under the rules, valued at fair market value based on comparable sales, unless it's part of a farm lot, and then they have the special valuation method that Mr. Steger referenced for farmland. There's a rule that in all events the value of timberland, but not farm woodlots, in any given county shall always be more than the value of managed timberland, as clearly an incentive to bring people into the managed timberland program. Now, a few issues. In recent years, there was this great anomaly that we knew that we had decreasing stumpage prices and values due to the construction downturn, which of course arose from the Great Recession in the 2008 and so forth. Yet at the same time, using the valuation method that we were using, actually the values were increasing. And we finally figured out how, and worked with the tax department, property tax division, figured out that was primarily the result of that the regulations embraced and called for a reference to a U.S. Forest Service guide that was supposed to be updated every year of stumpage prices around the country in different regions, different species, and so forth. And they basically stopped doing that in 2005. So we had the situation where we had the values that had heated up to 2005, and that was being the basis for valuing timberland in West Virginia, even though the real market had declined tremendously. There are some pending amendments to the valuation rules that will address that and basically rely more heavily on the far more accurate data that the Division of Forestry can provide. There's also some, in those proposed new rules, improvements and refinements of the way the capitalization rate is adopted, because it is an income method, as I mentioned, that we count apples with apples and don't double count inflation, for instance. Issue B, we discovered also that there was a lot of just obsolete and somewhat arbitrary soil quality measurements that are an important part of the methodology, so that you had a situation where, because of the county, the use of it county by county, the results indicated that a soil quality classification stopped at the county line. Well, we know that the good Lord didn't take into account where the county line was when our soil was first emerged, and so we have the benefit of some excellent new studies through WVU and the Division of Forestry that are going to we propose in these new rules will also replace these obsolete measures of soil quality. The third thing had been in the rules. There are literally per acre dollar minimum values in the legislative rules, and inherently they distort the methodology. You can't go below those minimums, and this is supposed to be an income method, and so we'll be addressing that in the discussion of the new regulations as well, that the industry will be making some presentations about that. The last set of issues, remember that I was focusing on that language back in the Constitution about that tax on value shall not exceed the rates in the property tax rates. Well, the severance tax rate, the severance tax is imposed on value. The value is harvested, and it is current. Of course, the 1.22 is right below the 1.5 that's the regular levy maximum for Class 3 property. But certainly it has been higher, and when you combine the property tax on the value of managed timberland and the severance tax on the harvesting of trees, I think a good lawyer can make an argument that the 3% or the constitutional limit of 1.5% has definitely been exceeded. I haven't heard that. There's no case on that, but there may be down the road. Excuse me. Interstate competition. No other state both has a severance tax on or no other state in our region, I should say. None of our competing market states have both a tax on the severance and a tax on the timber in place. That obviously creates a competitive disadvantage to West Virginia timber industry. And finally, item F, as favorable as some people believe that the managed timberland values are, there's still a tremendous amount of abuse in classification of land that that ought to be at least timberland, if not managed timberland, so as to be in class 2, as not only farm property, farm use, with both the rate and the valuation discount benefit, but even owner-occupied residents, and we've heard horror stories, that's where Roger Sherman could give more specifics than I can, about 1,000-acre tracts don't even have an abandoned cabin on them, and are not trying to treat it as farm, because you could put some bee hives out there and you'd have a farm, that'd be easy, but don't even go that far, and have it classified, convince the assessor that it's owner-occupied residential property. That obviously creates a distortion in the terms of encouraging people to get into the managed timberland program, and undermines the incentive that the managed timberland program is intended to be. So with that, I'll stop and be happy to answer any questions. Thank you.